as Bitcoin rises, we actually see a lot more borrowing demand. So when Bitcoin goes up, borrowing demand spikes and rates start to spike. So it starts to become very profitable to be lending in this kind of market.
Hey everyone, this is your weekly markets outlook on CoinDesk, where we take a look at what's happened in the crypto markets this weekend, provide insights into navigating the road ahead. Jenn Sanasie here with my co-host Andy Baehr, and joining us on today's show is Maple Finance co-founder and CEO Sid Powell. Hey Sid.
Hey Jen, hey Andy, thanks for having me on.
Thanks for being here with us. Now we're sitting here near the end of the week. Talk to us a little bit about what you've been watching in crypto markets. What are you really paying attention to?
It's been an interesting week so far. One of the things that really caught my attention earlier in the week was we saw a point from JP Morgan that they would consider doing Bitcoin-backed loans. This is not too surprising to see off the back of the Genius Act getting passed, as well as some pretty meaningful progress on the Clarity Act and, giving regulatory clarity to the market. But I think you're going to see, as we saw with stablecoins, you're going to see more of these traditional players start to come in and express interest in Bitcoin-backed lending. We already saw Cantor come into the space last year, and so I think you'll see a pretty strong trend here.
I want to pick up on that a little bit, Sid, because it feels to me, and I'm getting to know your business, but it looks like you take the best of both worlds from the banking side and let's say from the DeFi pool side, where you know your counterparties, you have relationships with them, and you make collateral posting as efficient as possible. But at the same time, everything's on chain. So the biggest friction cost for many people in our industry is on-ramping and off-ramping. So do I have that right? Is that kind of what Maple adds in terms of service that it provides to its borrowers?
Yeah, I think that's a fair point, Andy. What we find is that our clientele tends to be very institutional on the borrower side. So when they come to us, they're usually holding Bitcoin or some other large cap asset, whether it be ETH or Solana as well. And they want the protection and the safeguards of being able to hold that in a tri-party account. And so the fact that we are indeed integrated with all of these custodians, whether it be Anchorage or BitGo, or others, gives them an extra degree of comfort as to what's happening with their collateral that they just wouldn't get if they went to one of the fully on-chain solutions. So that's where we sit in between. But as you pointed out, unlike a pure play lending protocol, whether it be an Aave or a Compound, we know all of our borrowers, we sign legal agreements with all of them, and ultimately we have recourse to them if there is something wrong with the collateral at the end of the day.
Midnight is a privacy-enhancing blockchain, introducing vital, programmable privacy and selective disclosure capabilities. It means DApps can allow users to control what information is revealed without putting sensitive data on-chain, allowing you to break free from the limitation of choosing between utility or privacy. We deserve more when it comes to privacy. Experience the next generation of blockchain that is private and inclusive by design. Break free with Midnight. Visit midnight.network/breakfree.
Right. So your customers on the other side, your asset management customers who help participate in those pools, they know that they're dealing with a group of lenders who's going to be a little bit more stable because they've taken the time to engage with you and do these loans. They're not quick in and out borrowers, but also that they're going to be of a certain quality and that they trust your methods for assuring that, correct?
Yeah, that's right. For us, it's not good business if we're out there liquidating our clients. So we tend to choose clients who are larger in size, who we can be assured that they're going to post more collateral if there were a dip in Bitcoin or market prices. To date, in the 18 months since we started doing the over-collateralized product, we've only had one partial liquidation over that time. So I think it attests to the quality of the borrowers that we have and the relationships that we maintain with them. To one of the other points you made, Andy, generally we find our rates are a little bit more stable because we're offering fixed rate loans to these borrowers. And so instead of the rates whipping around as you might see on a pure play DeFi protocol, tends to be fairly stable and tends to be a little bit higher than the DeFi protocols just because there's those extra elements, posting native Bitcoin and being able to use a custodian and a tri-party account to manage counterparty risk.
Jen, save me for going too deep and nerdy, okay?
Well, I was actually going to ask a little bit of a follow-up there. I mean, can you tell us a little bit more about demand you're seeing from the institutional side when it comes to these borrowing products? And I know the Genius Act was just signed, but I can imagine you're expecting that demand to grow as we get into the second half of the year.
Yeah, I think we see a number of tailwinds for growing demand as we go into the second half of the year. And I think you've got the Genius Act is going to create more stable coins. We're at about 260 billion outstanding today. We think that is going to grow to multiples over the next couple of years. And that ultimately means more stable coins for us to lend out. What benefits stablecoins benefits our business. But just linking it back to the markets a little bit, what we find is that crypto lending is in some ways almost inverse to traditional markets. So when the market senses rates are going to be cut, risk assets like Bitcoin tend to trade up. And what that means is that it actually pushes up the borrowing rates against Bitcoin, because basis funding rate or the futures rate starts to go up. And that acts almost like your risk-free benchmark. So at the moment, we're starting to actually reprice some of our loans up, and folks who are lending on-chain, whether they be doing so in Aave or Morpho or with us, are starting to see higher rates come through off the back of the recent climbs we've seen in Bitcoin price. One other point to add just before I finish is that as Bitcoin rises, we actually see a lot more borrowing demand. So when Bitcoin goes up, borrowing demand spikes and rates start to spike. So it starts to become very profitable to be lending in this kind of market.
That's exactly what I was going to ask, the correlation between, I guess, price direction and rates, or equivalently demand for borrowing. We've seen in the second quarter fantastic breadth, right? So Ether did fantastically well. The CoinDesk 20 was up, which is our broad-based index, was up fantastically in the second quarter. The breadth is good. I guess Bitcoin did great as well, but it was really Ether, Solana, XRP, XLM that really kind of shown. Are your borrowers deploying into those assets more aggressively or tactically with their loans, do you feel, or is most of your borrowing base just a kind of a more pure Bitcoin borrowing base? In other words, does this kind of alts rush and acceleration have the same effect as a Bitcoin price rise when it comes to your rate levels?
Yeah, it's a really good question. So you have, in this kind of market, you have the folks who just want to borrow to kind of go levered long Bitcoin. But when you see, the beginnings of an altcoin season, and we've seen that, you've seen the index of altcoin performance relative to Bitcoin start to rise. It's not in what I would call euphoric territory yet, but we are seeing coins like ETH, Sol, XRP start to outperform Bitcoin. What that means for us is that we start to see more demand for borrowing against these coins. We have folks at the moment, we're starting to see more inbound for borrow against hype as well. We've seen some inbound for borrow against XRP, against ADA. So you do start to see a little bit of an increase in what I would call breadth of the collateral. But also a lot of our clients, they might be primes or OTC trading desks. So they tend to maintain a core position in Bitcoin. And if they can borrow against that, keep their long exposure and use the loan proceeds from us to start offering settlement or other forms of trading finance to their clients, that activity picks up. So that's one of the reasons that general price appreciation just drives more demand from our clients. And also, of course, a general wealth effect. Like if your portfolio has increased by 10 or 20%, you have more capacity to borrow the same way you would if your house doubled in price.
I guess looking from the other side, and again, bringing it back to the markets, there was a big opportunity. Actually, Jenn and I did a segment not that long ago before this last big pulse up where we were thinking, implied vols were going lower, funding rates for perps were going lower, rates were going lower because Bitcoin was stuck in this range right before this last big jump over the last couple of weeks. I guess your lenders who are on the asset management side are going to be similar, right? They're going to be yield seekers unless they detect other big opportunities. So does your change and shift in rates, is that also linked to the supply on the asset management side of your business, right? As capital evacuates to that to go chase an altcoin season, you have to raise rates to make it more attractive for them to come back.
That's exactly right, Andy. That's kind of the dynamic of the market. And you can see that not just with us, but you can also see that with some of the DeFi protocols like Aave and Morpho and Euler. What happens is that as prices are rising, people are pulling their capital. So the utilization on those protocols is going up because people will pull to go and invest in market beta. They want to be long the appreciating asset instead of collecting yield. And it can definitely flip very quickly. Like only a month ago, seems like ages given how fast the market moves, but only a month ago, we were actually sitting on a lot of inventory and utilization was coming. because it was very attractive to just collect yield. Now, as prices have risen, borrowing demand spiked. So we're now fully deployed. So we're basically making the maximum amount that we can be, and we're raising rates. And we're doing that. We're raising rates as well to try and keep lenders, the capital providers, on the asset management side of the business, in the market. Like as their opportunity cost grows, we have to be conscious of paying them a higher yield, to keep them in business with us.
Another big narrative this week was ETH treasury companies buying a bunch of ETH. Before that, it was Bitcoin treasury companies. Now we have BNB treasury companies, Litecoin one. Are these companies coming to you to maybe borrow against the assets on their balance sheets? Talk to me a little bit about that.
It's a relatively new phenomenon, but we definitely consider this an attractive segment. So the short answer is yes. Some of them are in conversation with us about borrowing against their treasuries. The concept was actually kind of first pioneered by Saylor back in 2021, 2022. They had a facility with SVB. Obviously, it was much smaller in size relative to where Strategy is now, but it shows that having a line of credit against your treasury assets can be a useful tool because it gives you a way to opportunistically purchase dips if ETH or BTC prices were to retrace. And generally, a facility like this is going to be more flexible, so you can draw it down faster, and it's going to be lower cost. You've seen a recent, influx of investors into these treasury companies, but it's worth noting that the folks who are putting money into these pipes and converts, their internal hurdle rate is not 8 or 9%. These people are trying to hit 15, 20% and above. And so that actually ends up being very costly capital. So we can come in as a cheaper financing partner that allows them to tactically buy dips. And we have spoken to not just BTC and ETH companies, but we're also talking to some of the treasury companies doing a range of other assets. I think it's going to be a trend here to stay. It hasn't played out just yet, and we're kind of keeping tabs on it and exploring options.
Fantastic. I think what happens when you have a new borrower come in with a giant size, and there must be you can't immediately expect the lenders to come in instantly, or is that baked into the contract? How does that fluidity work?
We would be prepared to fund relatively quickly with one of these companies because we generally have a liquidity that we keep spare to fund new loans. I think what we found, though, with a lot of them is that they do have a rather long timeline. So they might have made the announcement a week ago or a month ago, but they may still have another 30 days before they're in a position to actually do a deal with us because they have to clear, conditions precedent. They have to settle the funds, buy the assets, and just get their governance in order. So I'd say that's probably the reason we haven't fully won yet. But I haven't seen any signs of it slowing down yet. And I know some people are concerned about the company's asset premiums going to a discount. I think that's actually going to be the other case where it could then be useful for them to just borrow against their assets. It's cheaper to issue shares when you trade at a premium. It's more expensive if you trade at a discount, and that's where it might be worth considering a line of credit or some other option like on the debt side.
We got to wrap up in just a second, but I want to ask you, as you look forward to the weeks to come, second half of the year, what are the big milestones you are watching out for?
So I think, like everyone else, I'm kind of keeping an eye on what happens with the Clarity Act. I think this is going to be really important. I say that as a builder based here in the US, but it's going to be really important to bring back DeFi builders and entrepreneurs to the US and kind of strengthen the sector locally. I am keeping an eye out for, on the macro side, any potential rate cuts coming up, because I think that is going to be kind of a catalyst for more of what you pointed out earlier, Andy, a little bit more of alt season, which is really going to kind of be when the pace picks up within the space. And then the other thing I'm keeping an eye on is I think the DeFi sector is just performing really well. As an investor, I'm kind of looking at trying to allocate among the DeFi sector, and I do expect it to kind of outperform relative to things like meme coins over the rest of the year.
Thanks so much for joining our markets show. We appreciate your insights, and I'm sure we'll talk to you again soon.
No problem. Thanks for having me.